is avoidance. We are pleased to have with us today Peter Vitaliano, Vice President for Economic Policy and Market Research at National Milk Producers Federation. Peter is responsible for all the economic analysis supporting national milk programs related to domestic and international dairy policy. He has also provided all of the market analysis for management decisions for the cooperatives working together since its inception in 2003. Peter earned a PhD in agricultural economics from the University of Wisconsin-Madison, a master's degree in mathematics from Penn State, and a bachelor's in mathematics from Indiana University. Please help me welcome Peter Vitaliano.
Thank you, Ken. It's a great pleasure to be here. Just a few quick things to say before I start. Apologize, my voice is continuing to recover from a head cold. And more importantly, on behalf of National Milk, I thank you, members of Michigan Milk Producers, for your continued support of the Federation. I thank you for your continued support of the Cooperatives Working Together, CWT program, and appreciate your good remarks, Ken, on both of those organizations. Okay, we're a little behind schedule, so I'm going to talk to you about milk prices. I could talk to dairy farmers all day about milk prices. I'm going to choose what I talk about fairly carefully. In terms of time, I'm not going to avoid any. I'm going to give you bad news as well as good news. Milk prices were great last year. You don't need me to tell you that. But to give you an orientation to the national statistical indicators I use in my work, this is last year's milk prices month by month based upon USDA's broadest measure of milk prices received by dairy farmers throughout the country. It's something called the all milk price. That's kind of an outdated term that refers back to the days when USDA reported separate prices for grade A and grade B milk. They no longer do. But you saw we have it kind of a double peak here. To give you some orientation, that dotted line is the highest ever level of this indicator, this monthly all milk price, had ever achieved prior to last year, prior to January 2014. We spent all of last year basically in record high territory for this price indicator. Something clearly unusual happened last year. What is it? Well, let me show you this chart as an introduction to tell you exactly what happened last year. This is a chart I've been doing for a couple of years. It shows, in this case, year by year, I'd also do this monthly, the percentage of U.S. milk production that is exported, what we contribute to the world market. And the blue line below it is the same equivalent percentage of what we import in terms of dairy, all products, dairy and all products. As you can see, our exports have been growing. Last 2 years, we exported the equivalent of 15.5% of our production. That's major. That's where a lot of our production and strong prices are coming from, that world market. But although it's cliche to say we're in a global marketplace, in a sense we are, but we still are in, your milk is still marketed in two different markets. The domestic market, the 85% from this graph. The domestic market, U.S. dairy farmers have that market basically to yourself. We import about 3%. That's no longer significant enough to have any impact on prices. You enjoy that market. The domestic market is a very stable market. Our population is growing by about 0.75% a year. Consumers' taste in milk and dairy products is pretty stable. There are no huge surprises. There's no, yeah, we have this long-term decline of fluid milk consumption, but we have a long-term increase in cheese consumption and other products. There are basically no big surprises come from the domestic market. It is a very dependable market. The world market, that 15%, is a different animal. It swings around a lot. And we have major competitors. Particularly, the major ones are about half a dozen very large, very experienced, very sophisticated, and very flexible dairy companies in Northern Europe and New Zealand. Primarily their near monopoly exporter, Fonterra Cooperative Group. It's a very different market. And Basically, the big changes that you have experienced in recent years have come from the world market. The price disaster of 2009 came from something went on in the world markets. The incredible year last year came as a result of something in world markets. Very briefly, China, one of the biggest importers, dairy importers in the world, is also a major producer of milk and dairy products. Not nearly enough to supply their growing needs, so they import a lot. But China made a major change in its milk production system and still in the process of that, converting from a lot of small dairy farms with a very loose collection system. That's where that melamine contamination came in, rapidly changing to a bunch of very large dairy farms, well managed, with a much tighter milk collection system. The transition did not go smoothly. 2013 was a very large shortfall in domestic production. To nobody's surprise, they found out that those new managers of those big farms weren't able to run them as efficiently as they thought on paper. As dairy farmers, you know, you have a complicated job. You just can't stick somebody in it and expect them to do very well. They expected a lot of dairy cows to come over from those small producers going out of business, go to the large farms where they'd be more intensively managed. Well, beef prices were high, and a lot of those cows went to beef. So in the middle of 2013, China came onto the world market and almost in a panic imported huge volumes of dairy products, primarily whole milk powder, which they reconstitute to a lot of products, infant formula amongst them. And they came into the market at a time when the major export suppliers, the US, New Zealand, those big European companies I mentioned, weren't experiencing any increase in production growth. So you had this flat supply and this huge surge in demand coming on it. World prices just exploded. They rose well above our domestic prices. And although China kind of quit buying in early 2014, the residual shipments from those earlier contracts continued throughout the first half of last year. And those prices, particularly in the US, we continued with some momentum all the way into the fall to benefit from that. But when China stopped buying early last year, world prices started dropping. Other countries started importing a bit more. They've been crowded out of the market, but not nearly enough to make up for it. So the world market came down last year. So if you want to thank somebody for your milk prices last year, thank the Chinese. Thank, in particular, those new managers of those big farms that couldn't figure out what they were doing right away. Thank all those little dairy farmers that sold their cows to beef rather than to the big farms. That's what happened last year. And as I say, the world market can bring surprises, positive or negative. Generally, that is positive. It's not a steady progress, but the long-term outlook for the U.S. dairy industry is this is going to continue to grow. Okay, let's start. Okay, one more bad news slide. You remember that last year's prices came down very quickly toward the end. Let's look at what happened. This is sort of a snapshot of a sort of USDA's kind of very, very simple summary market outlook. The last 3 months of last year when those prices were coming down, milk production was up in the U.S. 3.5%. Total commercial use, domestic and export, hardly budged. It's up a bit more in the domestic market. Exports were down. Imports were up a lot. They say that's a small number, not economically significant, but kind of an indicator of which way the markets are going. And stocks in particular, stocks that are, the higher the stocks are, the more pressure there is in your price, rose during this period. Okay, let's start looking this year, and relatively speaking, the news is better for this year. Okay, this is the same chart, but I've added all of 2015. This is USDA's projections. Milk production is going to be up currently, by their current projection, at 2.5%. Sounds like a lot, maybe it is. But USDA puts out these forecasts every month. They update them. And each month now, USDA's forecast of how much production this year is going to be up over last year keeps coming down. 3 or 4 months ago, they were looking at 3.5% up. They've dialed that back, and I think they're going to keep dialing it back some more. Total commercial use, now that's it's kind of an artificial construction, the way USDA puts this together, but they're basically saying the commercial markets will grow about the same amount as milk production will grow, that production is needed for commercial use and is not going to end up in surplus. It may be a little rosy scenario, particularly this 4.2%, they're showing the domestic market going up. Commercial exports are still going to be down this year. Imports will drop off a bit, but stocks, they're forecasting basically will stay the same. Now let's look for a second at that domestic commercial use. I'm not going to put a lot of slides up here, but it's kind of mixed. Cheese consumption continues to grow. That's a major part of our domestic market. Probably even more fundamentally, milk fat consumption continues to grow. I've not broken that out here. This is sort of a milk equivalent of, based on milk fat and milk solids, non-fat. But if you look at October, December, when milk production was up 3.5%, that meant milk fat production was up about that amount. Butter, as you know, since you operate a balancing plant here, when milk fat's in surplus, it usually shows up in excess butter. Butter production during that period did not grow. Butter stocks have not grown. What's happening? Well, in short, the American consumer is rediscovering milk fat and how good it tastes and getting some relief from all these negative dietary messages that fat had been getting for many years. You've all seen the stories about butter is back and et cetera. It's not just butter. Milk fat consumption has been growing, I think, throughout the entire dairy marketing channel. If you look at the statistics on fluid milk, yeah, fluid milk is down, class 1. But the whole milk, the 2%, the higher fat products are not down as much. They're growing relative to all of fluid milk. It's the low-fat products that are dropping off. I talked to one of our members that's in cheese. Their whole line of cheese production is moving up in terms of milk fat content. Their lower fat products are dropping off. They used to be a net supplier of cream to the market. They're now net buyers of cream. 2 years ago, the whole United States had excess cream. We at CWT saw all kinds of bids to export butter. There doesn't seem to be much cream surplus in the whole country. Now, yeah, certain areas you've got some surplus. We're seeing very little butter being offered to CWT so far. That may change, but when you look at butter fat, milk, the milk fat part of the class 1, class 2, class 3, and class 4 price is a significant part of the price. That is holding up. Domestic consumption of milk fat is doing a lot to hold that up. We're still holding butter prices of about $1.65. Considering this big drop-off in prices, that's not too bad. Same thing with class, we're still holding about $1.60, about $1.55 in cheese prices. Well, let's look ahead to what the prices, this is last Tuesday's futures market. This is the forecast, my forecast of what that all milk price is going to look like. Okay, well below 2014, well below that all-time high average. But let's get some kind of a benchmark here. That brown line in here represents, I'm going back to 3 recent years, 2011 through 2013, and that's month-to-month average of those 3 years. 2010, 2009 were way too low. 2014 was way too high to put in this average. So these are 3 recent years when the milk price wasn't too bad. Now, for dairy farmers as a whole, those 3 years were a little tough, but it was mostly because of feed prices. You probably didn't feel that as much up here because you grow so much of your own feed. But at the moment, we're looking at milk prices being not too far below the reasonable price levels of those 3 years. Now again, this is just the futures markets. The way the futures markets go, there's a fair amount of information. You go out 2 or 3 months. You go out beyond that, it's a little hard to say. Okay, more fundamentally, what are your margins going to look like? Okay, you've all heard of, you all know the margin protection program has that national margin indicator, the all milk price minus a formula for feed prices. It's a pretty good indicator of what dairy farmer earnings are going to look like. It's going to be officially announced on a bi-monthly basis, 2 months at a time, and so that's what this graph refers to. Those two lines, the brown and the blue line, are two publicly available sources of forecasts for that MPP margin indicator. One is actually from the USDA website. It's designed and maintained by a bunch of land-grant university economists, but it's sort of officially USDA's forecast. The red one is mine. It's, all three of them are based on the futures markets from Tuesday. The only difference is how we interpret all those different, there's no futures contract for the all milk price. You've got class 3 and got class 4 and some of the products. It's how you build it up in terms of what that margin is. Same thing on the feed cost side. We got to make a forecast from the futures markets of corn prices, soybean meal prices, and alfalfa hay prices. You can see that these are all roughly in the same ballpark. And you recall from MPP program, $8 a hundredweight is the highest level of margin that you can insure against. The other two forecasts are showing that we're hardly going to even dip down into that insurable range. Mine's a little bit lower. But again, let's go back to those 3 years of 2011 through 2013. From a margin perspective, nationally, they were not real good, but it was not necessarily the disaster of 2009, for example. So that lower line shows that all three of these forecasts at the moment are looking at the margins, your milk price over your feed costs, are going to stay pretty well above that 3-year average, which was not great, but not necessarily a disaster. So again, that could change, particularly the out years. I'd say that there's probably a little bit more, too much optimism going out in the milk price, going out in those last several months. But to summarize, and this is kind of the good news slide summary, what I call positive factors for the U.S. milk price outlook this year. We're going to have more milk production, but it may not significantly outpace total domestic market growth. Exports are going to continue to lag, but focusing on the domestic market for the moment, there is strength in domestic cheese and milk fat consumption from American consumers. It's going to hold prices up. Butter and cheese stocks are not yet building significantly. That's what really hurt us in 2009. Particularly cheese stocks built up to over 1 billion pounds a month. That's what kept the price down so long then, into 2010. Our domestic butter and cheese markets are partially insulated. This is a structural issue from lower world market prices. We don't export that much of our butter and that much of our cheese. We export normally about half of our powder and whey products, and the prices of those dry products generally stay very close to world markets. Butter and cheese, we can maintain a price gap, and that's where the CWT program works. By moving additional quantities of butter and cheese into the world market, we can, as Ken's slide showed, we can make up for that price gap, and we can actually increase it a bit. That's where CWT generates the returns to dairy farmers, by focusing particularly on the milk fat containing products. World prices have been coming up in some cases, continue to drop a little bit for cheese, because Fonterra has been temporarily backing into cheese away from whole milk powder, but they may be finding a bottom. World import demand is expected to pick up in the second half. It's now looking like maybe the fourth quarter. But the Chinese are eventually going to have to come back into the market, and the world markets will get back to some level of normal import demand. We're going to go through a good part of this year, as we went through a good part of the second half of last year, with imports generally being lower than normal. They can't hold off forever. The U.S. has been maintaining its market share in exports, particularly through continued aggressive use of CWT. And also our competitors, those big European, those dairy farmers in Northern Europe, and New Zealand. They don't have quite the cushion you do here. We've got our fairly big and strongly growing domestic market, as I've talked about. Europe is kind of on the verge of another recession. They're not seeing that much additional domestic market growth. And Europe, as a whole, experienced almost 5% growth in milk production last year. That's almost unheard of. They have a production quota system that's coming off at the beginning of next month. Most of that additional production had to be marketed on the lower world market prices, and those companies have much more, they don't have federal milk marketing orders. They don't pool their prices. They've been dropping them pretty significantly, and I think the European dairy farmers are going to be getting much lower prices, even lower prices than yours. New Zealand dairy farmers are getting about $14 a hundredweight now. And New Zealand farmers used to be able to survive on lower prices, but no longer. Their costs have gone up. So actually, you know, your dairy farmers amongst your main competitive countries of Northern Europe and New Zealand are getting lower prices. That's going to impact their production, help keep things down on the supply side. So if U.S. milk production growth is absorbed mostly commercially, there's not going to be a large surplus of milk on the world markets this year the way there was last year. And with demand recovering, if we can continue to keep our cheese and butter prices about where they are now, mainly with strong support from the domestic market, keep our exports flowing through CWT, I think we'll be in reasonably good shape this year. It's still a little uncertain. Usually by this time of the year, I've got a very good handle on what's going to happen for the year. There still could be some shoes to drop, so I'm not going to tell you unequivocally it's going to be a great year, relatively speaking. But if you're doing, you know, it's not going to be last year, but it's not looking like it's going to be a disastrous year, anywhere like 2009 when we last had a hiccup in the world markets. So with that, concludes my remarks. I don't know if they have time for any questions, but I greatly appreciate your time and enjoyed speaking with you. Thank you very much.